So I have over 8,000 subscribers here, dividend investors, and we discuss a lot of stocks on this channel, dividend stocks. If you check out the comments below on this video or my other videos, you'll see a really active discussion here. And one of the stocks that has never really come up to my memory, I don't remember this one coming up, is one of my core holdings. In fact, it's my number four favorite dividend stock of all time. And I am so surprised about this. I am so surprised that I've not seen this stock come up in the comments, in the discussion. I think it probably comes down to the fact that right now, the stock is not necessarily on sale. It's probably at a fair valuation right now, given the stock market that we're in. It was on sale a few years ago, but that was before this channel. So maybe it's just a reflection of the fact that there's not necessarily a ton of value on this stock right now. That being said, this is one of those stocks that never really goes on sale. It had a little bit of it in 2015, but it never really becomes a deep discount. It's one of those stocks that is always just a really, really attractive stock, and I love this company. And so anyways, I will link in the description below. If you've been following my channel, you know I've been doing a series here about my personal top favorite dividend stocks. These are stocks that I own that pay increasing streams of dividends over time, the ones that are most core to my portfolio. And if you've been following, you know that Johnson & Johnson is number 1, PepsiCo is number 2, and McDonald's is number 3. And you'll also realize that when I am discussing these stocks, they're all a little bit unique. I don't pick all of my top stocks in the same industry. These are my core holdings. These are the ones that are most important to my portfolio, to my cash flow, to the dividends that I receive. So they all have to be a little bit different. J&J, obviously a healthcare company, Pepsi, consumer non-cyclical, and then McDonald's, a restaurant/real estate play. Number 4, it's an industrial. I couldn't pick another consumer non-cyclical or another healthcare company. I needed to pick an industrial because I always go for diversification in my personal stock portfolio. Anyways, if you have not guessed by now, my number 4 favorite dividend stock of all times is Untied Technologies. So let's get started with today's dividend stock analysis. So welcome to the video. It's UTX, Untied Technologies. That is my number 4 favorite dividend stock of all time. This is a diversified industrial company, and I have an interesting history with this one. I got into the game with Untied Technologies pretty late. I started buying in 2013, and this is pretty recent for me. And the reason I like this company so much is it gives me exposure. It gives me diversification. If you've been following my channel for a while, you know that I love consumer non-cyclical stocks, and I talk about them all the time. And I bet a lot of you are surprised here that, Ian, your number 4 stock, it's not Kimberly-Clark or Procter & Gamble. Ian, what are you talking about? Look, those are really high up on the list, and as I go down my favorite stocks, this won't be the last video, by the way. You'll see those ones popping up pretty shortly here. But number 4, it is Untied Technologies, and I got started with this a little bit later. And for that reason, Untied Technologies, it's actually in terms of size in my portfolio, it hasn't made it up there to core stock yet. It's kind of in the medium bucket in terms of its size, but in the way I think about it, it's a core holding, and I'm actively building it. And I'm actively building it actually slowly but surely, even right now, even though the valuation is not that great. There's certain stocks that I feel comfortable buying really at any time, especially when I'm trying to bring them to the appropriate sized position in my portfolio, especially when I'm going to be counting on them as a pillar stock, a number 4 stock to pay my dividend checks that I can live off of. And so I feel comfortable with it that way, but certainly I was not early to this one. I started in 2013. And so for those that don't know, what is Untied Technology? What do these guys do? Well, it's a diversified industrial company. They have 4 main business lines. The first business line is Otis. This is the elevator company. I believe they're the number 1 elevator company around. These guys are amazing, amazing elevator company. And what I love about that business line in elevators is they're not just selling the elevators, they're selling the maintenance plans that goes with them. So you get some recurring revenue and maintenance out of out of that Otis elevator brand. So amazing. What else do? They do UTC climate controls. Did you know these guys, it's actually, I have my air conditioning running right now. We're kind of in the month of June now, and it's starting to heat up here. And did you know these guys provide HVAC equipment for both residential and commercial? And one of the brands that is very well known that they own is the Carrier brand of HVAC equipment. And so that's the UTC Climate Controls division. They also own Pratt & Whitney. This is an aerospace airline engine company. They provide airline engines to many of the airlines out there. In fact, I just read a news article. It sounds like Delta is going to be purchasing quite a few Pratt & Whitney airline engines. And then the fourth division that these guys have is UTC Aerospace Systems. So in addition to Pratt & Whitney, where they do the engines, they also provide other products and services for the aerospace industry. And so these guys are quite diversified. I like that. Industrial. Anyways, the reason I'm bringing that up first here is it gives me diversification. As someone historically that's weighted a lot in consumer non-cyclical, I love having my number 4 stock, this industrial company. And quite frankly, I encourage you at home to do this. If you own a bunch of stocks, or maybe you don't, just think critically when you're going down your list. What's my favorite stock? What's my second favorite, third favorite, fourth favorite? Think critically. This exercise actually, before I did this video, actually, I was just thinking, what's my number 4 stock? It's real easy to pick 1, 2, and 3, but when it got to 4, I had a lot of different companies. And the reason I picked this one, quite frankly, is the synergies that it has with the top 3 stocks that I've already covered. And I'll link to all of those in the description below. It's that industrial synergy, that diversification that I love so much. So anyways, this stock, I purchased it at $95.67 in 2013. I bought some more in 2015 at $91 when it was on sale. My yield on cost, it is not very exciting. It's a 2.9% on this tranche that I bought in 2013. 3.1% on the tranche that I bought in 2015. And obviously I bought this stock quite a few times. I'm just highlighting 2 examples here of my history with this company. Currently it's trading at $127, so it's up a bit from where I first started buying this company. And it's yielding a starting yield of 2.19% right now. So not a huge starting yield, not by any means. And maybe this is why it doesn't get discussed too much in the dividend community. But that being said, I actually did a recent video, I'll link in the description below, to commemorate the 8,000 subscribers here. I did a video that talks about my 8 favorite tips for dividend investing. And one of the tips is not to be scared by low starting yields, because a low starting yield is oftentimes a reflection of a company like this one that is growing quickly. They're growing revenues quickly, they're growing dividends quickly, the business is growing. And so that's why the yield is a little bit lower. PE is 22.75, so in this market I would say not a steal, not a bargain by any means, but a reasonable PE ratio, a reasonable starting PE. And I am actually buying this company right now because, like I said, it's a medium position in terms of size, but in terms of the way I look at it, it's my number 4, so I better bring it up to size in the core category really quickly here, and I want to chip away at that piece by piece. Let's look at something really important here, the dividend history. Untied Technologies is a unique company in that they raise the dividend every 5 quarters. They don't do it every 4 quarters, they do it every 5 quarters. It's the only company I know that does this. It's really odd, but it's something unique to them, really unique to them. Anyways, I highlight some of the recent increases here from 2013 through 17. What's portrayed here is the quarterly dividend. And in particular, what I want to show you here is the growth rates. It grew in 2014 versus 13, 10.3%. 2015 versus 14, 8.5%. 16 versus 15, 3.1. 17 versus 16, 6. So you see some solid dividend growth rates here. Other than this 3% raise, pretty darn solid dividend increases. And we will get to this in a bit. They recently announced their quarterly results for the first quarter of 2018. They're amazing. They're phenomenal. So I expect the next dividend increase to be pretty big. I don't expect it to be a 3% or 6%. I'm thinking it's going to be a little bit higher than that. That said, they're doing a really big acquisition right now. We'll get to that a little bit later, so maybe that will weigh on it. Who knows? But I'm certainly hopeful for more of these kind of 8s and 10s and 7s versus the 6s and 3s, but we'll certainly see what happens with these guys. But what's interesting is I've had this YouTube channel a while, and some of my early videos I just talked about what I like when I'm looking for a dividend stock. One of the things that I always pointed out was I like companies that on average raise their dividend about 7% per year. This is the type of company that I think of when I say something like this. This is a company that on average over the long term, they've been really good about raising their dividend consistently and kind of targeting that plus or minus 7% when you average it all out, looking even at recent years here. So that's the kind of company that I typically look for in the dividend growth category. And look, my yield on cost, it's not great now, but 20 years out, it's going to be really good. And more than that, when I'm looking for a core stock, I'm talking about my number 4 favorite stock of all time here, it has to have that stability. It just has to be incredibly stable. It has to be almost disruption proof. And that's what I think of when I think of companies like Johnson & Johnson, Pepsi, McDonald's, United Technologies. And sometimes when it comes to a company like that, one sacrifices a little bit of yield. One pays a little bit more for that stability, for that world-class company. And that's exactly what's going on here with my number 4 stock. So I want to do this dividend video a little bit differently than some of the others. Rather than start with the numbers, you guys have all seen how I analyze the numbers. I'll talk about some of the numbers at the end. I first just want to start actually with the bigger picture. Today I'm just going to start with pros and cons because there's a lot of pros and cons with this particular company, and I think it's interesting to look at it just at a high level before we get into the numbers. So in terms of the pros, I've talked about this at length. Portfolio diversification. I need more industrials. This plays a great role in my portfolio in terms of diversifying my portfolio. That said, they also have company diversification. What I like about this company is they have 4 business segments. All segments are meaningful. They're all big numbers. Look at the annual report. It's on their investor relations website. They break it down segment by segment. They talk about each. The revenues that are coming from each segment are very meaningful. Not any one of the 4 segments is small or insignificant. They're all meaningful. So I love that diversification within the company. And sometimes we talk here about like ETFs or exchange traded funds or mutual funds. And investors have to sometimes think like, hey, I need a mutual fund to get that diversification because I'm concerned, what if one company doesn't do well? Sometimes though, when I buy companies, especially like these big companies that I'm talking about, like United Technology, it's almost like a mutual fund in its own right. This company has 4 business lines. Yeah, 2 of them are kind of similar, the Pratt & Whitney and aerospace, but look, the elevator division and the climate control division, the building division, those are kind of different. So you've got some diversification here. Yeah, they're all industrial. But that being said, sometimes I think investors look past this kind of thing and they think that they might need a mutual fund or an ETF to achieve diversification when sometimes the companies themselves, they do already present a lot of diversification. So just a point worth mentioning. I love these guys. If you've been following my channel for a while, you know that I like a company that's international because I like global exposure. And sometimes investors here on my channel ask me how I achieve global diversification and how I am not overweight just in the United States where I live. Well, this company actually has only 38% of its revenue coming from the United States. The rest is coming international, 29% Europe, 21% Asia Pacific, 12% other. So these guys have a ton of global diversification that's really meaningful to me. And the point here is sometimes people think, hey, to achieve diversification, one has to invest in a company that is headquartered, that is based, that is incorporated out of the US. And that is just not the case. With United Technologies, one achieves that diversification globally by simply purchasing a company that is based out of the US but does a ton of business, the lion's share of their business, outside of the United States. So I really like that about these guys. Urbanization, number 4. There is a global trend here towards urbanization. People these days like living closer to cities, especially younger people. And from what I've read and deciphered, these trends are not just in the US. These types of trends are happening everywhere. And even in countries like India and China that are growing incredibly quickly, people are starting to gravitate towards major cities. Well, it just so happens that this company is going to benefit from those types of demographics, those types of trends, because they provide those building blocks for building cities, elevators, HVAC equipment, the types of things that are needed to power cities. What else? These guys are going to hugely benefit from the global travel trend. I was reading a report. I don't have the perfect number. I can't recall the perfect number here, but it said something like only 20% of the people in the world have been on an airplane before, have been traveling via air. And by 2030, it was saying that it was basically going to double. And so there's this huge move towards global travel, towards airplanes, air travel. And it just so happens that a company like this, like with Pratt & Whitney and with their aerospace division, and in the aerospace division, by the way, they also do a lot of government work, totally separate point, but they're going to benefit from that trend. These guys are totally going to benefit from that trend, so I like owning it for that reason. Strong revenue growth. We will get to this a bit later, and honestly, I didn't write all this down, so I encourage you just to go to these guys' annual report. I'll link to it in the description below. I'll make it real easy because I think it's a good annual report. Check it out. They are achieving revenue growth and good revenue growth on all 4 business lines, so I love that. Top line growth doesn't get much better than that. And the fact that they can manage to do it across all 4 simultaneously, that's pretty cool. What else? Dividend growth. We already covered that, but they totally meet my needs from a dividend growth standpoint. Recent earnings were really good. We'll get to this in a minute. The recent earnings were basically stellar. In fact, I'll give you a preview here. The adjusted earnings per share year over year are up 20%. So this is the thing. We talk here, I've done a lot of videos recently, tech stocks, growth stocks versus dividend stocks. The growth investors typically think that these companies like Untied Technologies, who's ever heard of it? Oh my gosh, they make Carrier air conditioning units. They must be a slow growing company. No, that is not the case. This is a company with a huge market cap. I actually didn't write it down here, but they are growing 20% year over year on their earnings, despite being an old world style company, despite not being a pure play internet company. And I think this is a reminder to everyone out there that just because one is a dividend investor does not mean they're not a growth investor. I look at this as one of my growth stocks. This is a great growth stock. Moving down. Service plans. We talked about this a bit, but the types of products that they sell typically require service and maintenance plans, and they are happy to provide it. And so I love that about this company, about the Otis line of business, about all their lines of business. That recurring revenue element is amazing. What else? Just quality. We talked about this a bit, but being a number 4 stock, number 4 favorite dividend stock of all time, I've got to go towards the quality. It's a flight towards quality. And look, when the market tanks, and it will, what are the companies that are really going to hold their own? It's going, in my opinion, to be the companies that have the best quality. Just quality, bread and butter, amazing companies. This is one of them. Let's talk about the cons. Debt level is rising. Right now, debt is at $27 billion. I looked at their current ratio. They are more than enough money coming through the door to pay their debt, and the liabilities are not overwhelming to me, but the debt has been slowly increasing. And this is probably a good time to talk about Rockwell Collins. These guys are acquiring a company called Rockwell Collins. I honestly don't know much about them, but what I do know is it's a $30 billion acquisition. So this is a major acquisition. It's upmarket acquisition. Look, it's 2018. This market is on fire, or it's starting to correct, but looks in the scheme of things, it's on fire. 2018 is not the time to do an acquisition, but it seems like that's what everyone's doing. It just baffles me that everyone's doing this upmarket. But maybe the reason they're all doing it upmarket is they're just finding that this is going to help grow these companies. Maybe just it's easy to get financing now. Maybe it's easy to get deals done. Maybe Rockwell Collins, for example, didn't want to sell down market because they didn't want a low valuation. They wanted to wait till it's up market to get a good purchase price. In any event, it's happening, and they're paying for this thing with cash and stock, 67% cash, 33% stock. I like that. I'd rather have them pay with cash, take on a little more debt, than dilute shares. And so I like the fact that it's more skewed towards that side of things than issuing shares. But anyways, debt is rising. It'll continue to rise. they have more than enough capability to pay their debt down. And so I'm not very concerned about it, but it's certainly a con. And boy, this is a con I see with pretty much every company across the board. You've been watching my videos here, all my ones I linked to in the description. It's hard to pinpoint a company where the debt is not rising. And I just think that's kind of a industry-wide, dividend-wide event that everyone needs to keep an eye out for. And I hope these management teams at these companies realize that that trend can't continue forever. At some time the debt needs to get paid down, but it's certainly not what's happening at most of the companies that I look at or that I own right now. What else? Research and development. I didn't list the numbers here, but again, check out the annual report. I took a quick look at research and development, and what I like to see is research and development steadily go up over time. Look, we just talked about growth versus value, growth versus dividend. I look at this as a growth company, and a growth company needs to invest in research and development. This is a tech company. Tech investors will never look at it that way, or maybe not, I shouldn't say never. Most tech investors, when they think of tech, they're like, okay, I need to own Apple, I need to own Facebook, Google, Netflix, those types of things. But the fact of the matter is technology exists outside of the internet or outside of smartphones. Technology exists in jet engines. Technology exists in elevators. Technology exists in making HVAC equipment more efficient. Technology definitely exists in the kind of contracts these guys have with the military on aerospace stuff. And so this is a technology company, in my opinion, and but it's also a stable dividend company, so it's kind of the best of both worlds. So I love that about this, in that this company cannot get disrupted as easily the way something like a social network could. I look at something like a Facebook, I can totally see something like that getting disrupted because the barriers to entry are not the same as in something like this where many of the buildings around the world have their equipment already installed. You're not just going to rip out an elevator and put in a competitor. And so you're not just going to rip out an escalator and put in a competitor. And so there is a competitive moat here. And anyways, being a tech company, they have to pour money into R&D, and the R&D funding, it has kind of plateaued in the last few years, and I actually think I remember it going down a little bit, notching it down just a little bit, and so that's kind of a red flag. Not huge, they're still pouring a ton of money into R&D, but it's something that I want to continue to watch over time. What else? Cash flow from operations is down. I did some digging. I really went into the annual report and went into the fine print, and I tried to really understand why is cash flow from operations trending down over time. These guys have a pension plan, and being a company that's been around a long time, it's different than some of these newer companies like the Apples of the world. I don't know if they have pension plans or not, but it's probably a lot different than a company like this. Anyways, they recently took some pretty big investments in terms of funding their pension plans, in terms of having them funded, not having to worry about it in the future, not worrying whether it's going to be there or not. And so I actually wrote this down. They committed to a $1.9 billion contribution to their pension plan program. And of that $1.9 billion, $781 million was funded in 2017. And so that's one of the reasons the cash flow from operations is down. It's probably the main reason, at least that I can decipher from looking through the fine print of their annual report. Doesn't concern me. Certainly it's a con, but I want to see now the cash flow from operations going up over time. I hope they've now funded this thing, and I hope that their pension plan for new employees coming into this company is realistic. It's kind of a pro and a con. I like having a pension plan because it's probably going to keep people at this company and retain their talent. On the downside, though, I do believe some of these pension plans are hard to maintain. I know a lot of companies struggle with them, and they're very expensive. They're very expensive for companies to manage, and so there are pros and cons with it. I actually commend them for funding this thing and just taking the hit, getting it done with, and taking the hit while revenues are rising, things are going good. What else? They sold have you heard Sikorsky? This is a helicopter company, and this company was sold a few years ago. I think back in 2013, they sold it. They sold it for about $10 billion, $10 billion, something in that range, and it was sold to Lockheed Martin. And why did they sell this thing? I'll tell you why. They used the money and they bought back shares. If you look at their annual report that year, you see share buybacks, they spiked. with this sale. They took the money, they just bought back a bunch of shares. And I think from a efficiency standpoint, I imagine they just felt like this wasn't a core business. Maybe it wasn't as profitable or as much of a business they really wanted to have for the long run. In any event, what just kind of baffles me is they sell this. Then, and in 2013, it was not as much of an up market as it is now. They sold it, and then they buy Rockwell Collins now for $30 billion. And they don't have their $10 billion from their Sikorsky sale anymore because they bought back shares with it. So they're going to have to use current cash on hand, probably take out some debt, and issue shares to pay for this thing. So it's just confounding to me. And sometimes I almost think that executives at these companies, they've got to have an initiative. And I'm not trying to put anyone down here because these guys are amazing. And look, I love this company. There's so many pros. It wouldn't be my number 4 stock if I didn't think management was doing an amazing job. But I also have to be critical, and I think it's important for management at companies like this to take feedback from time to time. And one point of feedback I'd have is, look at the history. Why did you sell that and then buy this? They're kind of similar. They're not that similar, but if it were up to me, I would have kept Sikorsky, and I probably wouldn't have done this Rockwell Collins. That being said, from what I've heard, the Rockwell Collins acquisition is going to create something like $500 million a year in terms of efficiencies, because Rockwell is doing a lot of the similar things that United Tech is doing, and they can kind of cut some of that duplication to have more efficiency. So who am I to say? Honestly, I don't know anything about these guys' business the way the people managing it do, but that would be one point of feedback. I just find it kind of interesting, and it's kind of sad to see it go, because I really think that was an amazing company, and I loved having that helicopter component to this company, but things happen. What else? Cyclical. My number 1 company, J&J. People are going to need healthcare in a good economy or bad economy. Number 2 company, Pepsi. People are going to need to snack on chips in Pepsi Cola, whether it's a good economy, bad economy. Number 3, McDonald's. I imagine McDonald's will do better in a bad economy because people who may have more money in a good economy now need to spend more money at McDonald's because it's a more affordable meal. This kind of thing, good economy, it does great. Bad economy, probably not as good because it's cyclical. Think about it. If you're in the construction industry, you're a real estate developer, you're going to build probably more buildings in a good economy when it's easier to get investors money, when banks are more willing to lend money. There's just typically more activity in a good economy. And when there's that activity, people are snapping up Otis elevators to install in their buildings. You're an airline company. If it's a good economy and air travel is increasing, margins are good, ticket prices are high, maybe you're going to add some more airplanes to your fleet. If you do that, you're going to need some Pratt & Whitney engines in them. Bad economy, you're probably going to delay some of those expenses. You're probably going to wait on those expenses. And so this is a company, they keep their payout ratio lower, around 50%. Conservative, I like it. Room for expansion, but they also do this because they know they're pretty cyclical. That being said, this isn't that highly cyclical, and the way that they protect themselves from being cyclical is a fewfold. 1, service plans. You need to service your elevator in a good economy or bad economy because safety comes first, and the last thing you need is someone having an incident in your elevator, so everyone needs to service it. Good economy or bad economy, you need to do that. I think the other thing, though, is they're global. We talked about this before. US is only 38%. And being only 38%, these guys are global. And so, yeah, the entire global economy can tank at one time, but usually it doesn't happen like that. It's kind of more of a domino effect. Like US kind of goes first, then other countries, and kind of ripple effect. And you always have the emerging markets like India and China that are, I shouldn't call it really emerging as much. China's kind of established market, but growth markets, if you will, they may not face any kind of downturns, or maybe they will. And so anyways, the fact of the matter, though, is they're so diversified internationally, it buffers them a little bit from that. And the third way that they buffer from the cyclicality is just diversification across 4 business lines. And governments, for example, government contracts, aerospace, defense, that type of spending needs to happen around the clock. It's going to happen good economy or bad economy. And so that's something that shelters them from cyclicality. But that being said, it's an industrial company, and with industrial companies come the cyclical nature of cyclicality. And so anyways, those are the pros and cons. I love this company. I love the pros. I want to go now into a few things. I want to just talk about some high-level numbers, and then I want to actually go into their recent quarterly earnings report. So let's just look at revenue. 17, 16, 15. Revenue went from 56 billion up to 59.8 billion. So revenue's growing, real nice. Operating profit went from 7.2 billion up to 8.67 billion, growing real nice. Operating margin went from 13% to 14.5%. So what I like about that is these guys not only have grown their revenues and their operating profit, but the operating margin is expanding, so they're getting more effective with growth. As they grow, they're getting more effective, so I really like that. I really like it. Now, I didn't list much else here, and the reason being is their earnings per share, it's kind of skewed. It's all skewed and down, and the reason it's down is tax reform, tax consequences, and so the data got kind of murky, basically. But the reason, and I've done this in my other videos, I look at operating profit, is it comes before taxes. And because it comes before taxes, it's a way to gauge if a company is growing without having to worry about one-time tax events and tax law changes. So next, what I want to do, I want to go into Q1 of 2018. I think this is really key. When I saw this, I was just so pleased with this company. And quite frankly, this is one of the reasons I decided to buy some more stock even here in 2018. And operating profit, it is up for all 4 business units. Year over year, it is up. Earnings per share, it is up. It is up for 2018 for all 4 units. So sales are up 10% year over year. Sales have increased 10%. That is amazing. Again, this is an established company. This is a blue chip. One doesn't think of this as a very disruptive company. That being said, they're seeing some stellar revenue growth. And it's up 6% organically. And so 6% is happening organically. The rest of it is happening non-organically, meaning it's either through an acquisition or maybe it's because of currency fluctuations, something of that sort. But organically, they're growing revenue 6%. And as I mentioned, the adjusted earnings per share year over year, 20%. So they're really seeing some great trends there as well. And that leads me to believe that they're going to be just fine with the Rockwell Collins acquisition, and they're going to be just fine growing that dividend, which is what I need. Because look, let's get to the bottom of it. A 3.1% yield on cost, 2.9% yield on cost. That's not really going to help me retire anytime soon. But that being said, when I look 10 years out, 20 years out, I have so much faith in this company. I have so much faith that this is going to grow quickly. And even though the yield on cost and my starting yield is real low right now, this is one that I think could eclipse some of my other higher yields that I have right now because of its growth. And it plays a unique role on the team. If you know my portfolio, I've disclosed here on YouTube a lot of the stocks that I own. You know that different stocks play different roles on the team. This is one of the growth ones, but I have other companies on the team that have high current yields, have high yields, and they bring my income current. If, for example, I needed to tap into my dividends tomorrow, this probably wouldn't help as much because I'm waiting. This is deferring my dividends because it's a lower starting yield, higher growth. Some of those dividend payers that have a higher starting yield, they bring the cash into my hand now when I need it, if I happen to need it. So hey, thank you for watching the video. If you enjoyed it, I please invite you to subscribe, to like, to comment. All of that means the world to me. It's the best way that you can thank me. And I'd be curious, please put in the comments below. What do you think about Untied Technologies? Have you looked at this company before? I'm just shocked. I don't hear much about it here. And so I would be so curious what all of you think about this company. Before I leave today, I want to add a full disclosure. I own the companies, the stocks that I mentioned in today's video. So I am long. I own Untied Technology, Johnson & Johnson, PepsiCo, and McDonald's. Ticker symbols UTX, J&J, PEP, and MCD. I own those in my portfolio. Also, before I leave today, just a friendly disclaimer. This is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Hey, thank you so much again. I could not be more excited that we're over 8,000 subscribers here. We're growing quickly. Great community. So excited that we're all empowering each other towards our goals of financial freedom and cash flow, massive cash flow from dividends. I will see you in the next dividend investing video.